to our friends on the West Coast. Good afternoon to our friends on the East. And now it's time for the World on Finance with your host, Mr. Everett James. Hey, Ev.
Yes, good morning or good afternoon, depending on which coast you live on.
Well, I'm on the East Coast, so it's good afternoon here, and it's good morning there, my friend. So anyway, what's on the agenda? Uh, and I have a question. I'm sure you watched the State of the Union address last night.
Yes.
Okay. And what was your takeaway from that?
Oh my goodness. Well, I thought he did an excellent job. Covered a lot of topics in just 2 hours, but could have gone on, for more time because of all of the improvements in our um, cost of living and improvements in our general state compared to other countries in the world.
Mm, okay. All right. Well, that's your take. I have a little different take on that.
Of
But
course
it's
you
your
do.
show. Of course I do. Of course I do. Absolutely. I'm not going to take
That's
away from your program today, but I have a very different take on that because I thought it was packed. I thought it was packed with lies. I thought it
uh,
was packed with lies, but I'm gonna leave it like that. And I'm sure you have a lot to cover today, so I'm gonna step aside.
well, thank you so much, Mr. Brown, and welcome,
Okay.
listening audience. This is Everett James, your trusty tax reporter who comes to you on a weekly basis at 10 a.m. It comes at 10 a.m. on the West Coast, and for those living on the East Coast, 1 p.m. And we invite your participation. As a matter of fact, we have some special rewards for those who do participate by either calling my number at 951 522 9877, 951 522 9877. And for those who feel more comfortable on the internet, you can send us an email at evjtax1 at gmail.com. That's evjtax1 at gmail.com. Okay, folks, the special reward is a free assessment of your tax liability, and in certain cases, a free completion of your 2025 tax return. That is available for those who call in with questions and comments. And keep in mind that here we are already well into the 2025 tax filing season. You may recall the one big beautiful bill that is so heralded and mentioned by our current president, the 20 July 4th, 2025 signing of the one big beautiful bill that will be included. Some of the highlights of that bill will be included because it certainly affects your the filing statistics and results. The Before we get into some of those things, I do want to mention that the station it really is supporting a local travel baseball team. It's called Riverside United Baseball Club. It's for 9 and 10-year-olds. Unlike traditional baseball clubs, they do not charge a fee. Really, everything is funded out of the pockets of the sponsors. Cicely and Jason Wooten, Wooten. Folks, take this phone number down, 951 534 3838. 951 534 3838. Please call the baseball team to to sponsor these young men who have exceeded, the normal capacities and have amassed a record of wins that has qualified them to take part in some of the out-of-state tournaments. Please take that number down for your offers of help. And they are not just looking for financial help, although anybody who might be willing to sponsor them, pay for some hotel rooms that the players and the parents would be using for their participation. They can also use help in buying equipment, cleats, helmets, team jerseys, batting gloves, matching equipment bags. There's all kinds of things. So please give them a call, 951-534-3838. Okay. As you have noted, to begin with, the government shutdown continues on, at least in a part, as far as the Department of Homeland Security is concerned. Their funding has been delayed, but there are other government functions that have been funded, but not. So we are still operating on a very limited government funding arrangement. One of the things that we would like to just highlight this hour is something that pertains to California in particular, and may pertain to some other states, and that is the life cycle of Proposition 13. Everybody knows about Proposition 13 who owns property in California. And that is because that beautiful bill was brought to fruition by the Howard Jarvis Taxpayers Association in California. And they went out and collected well over a million the votes back in 1978, and they got that's over 1.5 million signatures to qualify for a statewide initiative that would finally end excessive taxation, protecting the security of property ownership, which came out to be Proposition 13. So they, at that time, back in 1978, the overwhelming majority of California voters voted for Proposition 13, despite a campaign of scare tactics. It turned out that nothing scared Californians more than opening up their property tax bill. Proposition 13 made property taxes predictable and manageable. The first thing, there's about 5 things that I'd like to highlight with you. First, Proposition 13 made property taxes predictable and manageable. It cut the property tax rate from an average of around 2.67% down to 1%. And to this day, even new homeowners are saving money compared to what they would have been paying. If you want to find out what you might be paying, had Proposition 13 not passed, check out the Howard Jarvis Taxpayers Association calculator. It can be found at this email, and it's guessinggame.org. Again, guessinggame.org. Take a look at how much you'd be paying in annual property taxes if Prop 13 had never passed. Okay, the second major thing, it limits the annual increase in assessed valuation, and it limits it to the rate of inflation, and that is capped at 2%. In other words, the assessor, when he applies, the percentage, um, he he can only he cannot assess that percentage above 2%. So even under Prop 13, even if a property doubles in market value in a single year, its taxable value against which the assessor applies the 1% tax rate, that assessed value can only be increased up to a maximum of 2% per year. So to begin with, again, the first major point is that the tax rate got cut from well over 2% down to 1%. Secondly, the Prop 13 limited the increase in the assessed valuation and limited to 2%. So it can only be the taxable value can only be increased up to a maximum of 2% per year. The third thing is Prop 13 requires reassessment of property when it changes hands. So, this provides local government with a predictable, a source of income, predictable and stable source of tax revenue, and which you may have noticed has grown virtually every year since 1978. And those increases often, the attempted increases often exceeded inflation and population growth. Okay, the fourth major point, Prop 13 also protected the taxpayers by requiring a 2/3 vote. And that 2/3 vote is required to pass certain tax increases. The fifth and last point is that a 2/3 vote is, particularly critical when it comes to property taxes. And that obvious reason is people can lose their homes if they don't pay their property tax bill. So the vote threshold has to be higher than just a simple majority of voters. So that has been established as requiring a 2/3 vote. So as Californians will note, the state legislature will continue to try to undermine Prop 13. So get a hold of, in touch with the Howard Jarvis Taxpayers Association. Pay the fees, to participate and receive information from them. And let's keep Proposition 13 alive and well. Okay, I think it would be wise, since we are in the middle of the tax filing season. I'm sure you're quite aware that folks do not have to itemize as much as they used to. And that's because of the first off, the 2017 Tax Cuts and Jobs Act that set a limitation of $10,000 on the amount that you can actually write off on the Schedule A for state and local income taxes. And that bill back in 2017 nearly doubled the standard deduction amount. But in the most recent legislation that got passed last July 4th, under Trump's one big beautiful bill, it has impacted our tax returns. And what are some of those major changes that are helping to taxpayers to not, um, drown in a sea of taxes? The first thing is that for those who are filing a Schedule A, the amount you can deduct is $40,000. It had been changed to $10,000 back in 2017, but per the most recent tax update that just got signed last July 4th, for those who are able and have properties that are assessed at a large local tax and state tax, you can deduct up to $40,000 as of the newest change. So this bill that was signed last July 4th means the higher state and local tax limitation applies to the 2025 federal returns that we're filing this year. It lasts that increase in the deduction amount. It actually lasts up to through 2029. At that time, at the end of 2029, the limitation will go back to the $10,000 limitation. So while this is good, keep in mind for those who have higher incomes, there is an income limit for 2025. It begins to that SALT, the abbreviated state and local income taxes. That limitation begins to phase out for couples. It begins to phase out at adjusted gross income who have more income or exceed the $250,000 limitation. So keep in mind, stay in touch with your tax preparer or CPA to make sure that you don't attempt to deduct more than what you're actually limited to per the limitation phased out amount. Second thing, major change from the July 4th one big beautiful bill that got passed last July. The charitable deductions, are available. But that's going to get a haircut, you might say, starting with the 2026 tax return. But the charitable, contributions are alive and well. If you itemize, for example, say your AGI is $232,000, and you donate $14,000 to a charity in next year in 2020, this year rather in 2026. If you itemize, you can deduct $12,840. And for those of you who are mesmerized by all of these limitations, if you call in this reportable, devote a portion of the weekly program, giving examples of how much you can deduct, but I won't attempt to take on the computations at this time because they're so technical. But call in your questions, and I'll devote the next part of the next week's program to explaining how it affects your own individualized return. However, in the meantime, folks who do not itemize, uh, which describes the majority of the taxpayers, they get a nice tax break for their charitable donations. Beginning with next year's return, or beginning with 2026 returns, they're going to be allowed to deduct up to $1,000 of charitable cash gifts without having to itemize on the Schedule A. The amount, what's the amount and that applies to individuals. What amount can a married couple deduct? Wow, for beginning next year when you file your return, that amount will be $2,000 for folks who are married and filing a joint return. Um, the Some of the other changes that will affect the 2026 return, I'll leave in advance and present those when we're closer to filing the return for tax year 2026. If are you a victim of any disasters that took place in 2025 last year? Know the rules for deducting personal losses. First off, the loss has to be suffered in a federally declared disaster. Your loss amount is equal to the smaller of the damaged property's adjusted basis, how much was the value reduced of the property, and that has to be you have to deduct any life insurance proceeds that you've received or expect to receive in the future. The In the one big beautiful bill that just got passed last July 4th, the amount there has been a change for personal disaster loss write-off, and that is going to be similar to victims of federally declared disasters in the period of 2018 through 2024. The question often comes now: how would you actually report that loss on your 2025 Form 1040? Well, first of all, you have to use Form 4684 to calculate the loss. Then, if you are itemizing on Schedule A, transfer the amount to Schedule A part at line 16 and write net qualified disaster loss. If you are not itemizing, you just have to follow the instructions on Form 4684 because they have special instructions for line 15 on the Schedule A. So keep in mind that the rules differ for personal losses from a disaster that began after July 4th. Only itemizers can claim a deduction, and there's two offsets that apply. Keep in mind that the loss is first reduced by $100, and then the balance is deductible only to the extent that it exceeds 10% of AGI. You can get additional instructions on the Form 4684 and get those in IRS publication 547. So something that you might want to be aware of in filing your 2025 tax return. There's a credit that's available that rewards low income folks who put money into an IRA, a 401k, 403b, SEP, or similar retirement plan. It's in the maximum savers credit of $2,000 for joint filers and $1,000 for others. Um, for 2025, the current filing season, the credit fully phases out at AGFs of over 39,500 for single filers and 59,000 for household head of households, and then 79,000 for folks who file jointly. So I won't tell you mention anything about 2026 tax year. Let's just focus on 2025, the current tax year that we'll be hoping to keep you up to date on. The know the rules for those who are interested in the American Opportunity Tax Credit. That's the tax credit for education, for your kids' education. That AOTC is the American Opportunity Tax Credit. It's up to $2,500 per student for each of the first 4 years of college. Up to $1,000 is actually refundable. The American Opportunity Tax Credit is based on 100% of the first $2,000 spent on qualifying college expenses, and the next 2,000 and 25% of the next $2,000. So there's a number of bends and twists in order to actually arrive at the refundable amount. Keep in mind that there is, for the American Opportunity Tax Credit, starts to phase out at modified AGIs over $160,000 for couples and $80,000 for singles and heads of household. Credit eligible. What are some of the eligible expenses? Well, they include tuition, books, and fees for at least half-time students. So for your students and your dependents, they do have to be enrolled in college at least on a half-time basis. If you're also using tax-free 529 funds to help pay for college, coordinating that 529 education tax break and the AOTC, the American Opportunity Tax Rate, that can be tricky. So, you cannot use the same college expenses for both of these tax benefits. And I would strongly advise staying in close contact with your tax preparer or your CPA to make sure that you're calculating those tax breaks accurately. And as I mentioned before, for those who call in and ask for additional clarifications, we can designate a portion of the following week's tax program on just that subject if you call in and request that special treatment. The starting next year for 2026, those folks who do want to take the American Opportunity Tax Credit, you got to have a Social Security number, and the college student, of course, also must have a valid Social Security number. The new requirement, that's going to be a new requirement, and that kicks in with the 2026 tax returns. However, for 2025 tax returns that we'll be filing this year, the filer and the eligible student both have to have a Social Security number or an individual tax ID number. Um, Keep in mind that next year, those items will not be accepted. You got to have a Social Security number, starting with the the 2020 yes 2026 tax returns. But you can still get away with claiming an eligible student for 2025. You can get away with an individual tax ID number, that ITIN number, but not beginning with taxable year 2026. The court, has been very, very active, particularly with the significant tax legislations that took place, back in 2017. And of course, the huge One Big Beautiful Tax Bill getting passed this past July 4th, called the One Big Beautiful Tax Bill. The now you've heard through the news and commentary about the egregious and totally disgusting violations of rules governing the exemption accorded to nonprofit organizations. Wow. The tax, a number of those violations have hit the public airways, not to mention the money that has been stolen from the taxpayers, particularly in Minnesota and California. But the tax court is going to be seeing quite a bit more challenges to those nonprofit organizations that decided to rip off the American taxpayer through their nonprofit 501c3 exemption. An example is with a group that was created back in 2001 to distribute powdered milk to children in third world countries. And IRS audited one of the organizations in 2020, and revoked the exemption after finding out that it operated a cafe and rented space in a building that it owned, and they were up there operating the cafe and renting the building out to tenants, but they wound up not engaging in any charitable activities. The tax court upheld IRS's determination, saying the group doesn't exclusively operate for charitable purposes. And that was in a court TC memo number 2026-1. Wow. And there's going to be a lot more of those tax hearings, particularly as more and more nonprofits have been discovered to be total ripoff of the American public, particularly in Minnesota and California. For folks who would like to have more control and more access to IRS, particularly over the internet, many clients are being urged to get what they call an IRS online individual account. If you did have an account, it does take a good bit of work on your part, particularly establishing your identity. But it could make your dealings with IRS a lot easier Some of what are some of the reasons that folks are getting these individualized tax ID accounts? Well, it could make it easier to pay estimated taxes. It could improve your access, getting more access to your tax transcripts and other records. You can look at digital notices from IRS. You can check the status of your tax refund or the status of an amended return. You can make tax remittances, and you can apply for a payment plan if you wind up having to owe IRS back taxes. You know, in order to create an online account, you either have to submit a photo of your government ID and participate in a live video chat with an ID.me representative. So, in order for you to start to consider obtaining one of these individual accounts, go to id.me represent id.me and on the internet id.me. The what's interesting is politically the activity in the courts is really ballooning, particularly those who hold a political position in the government. For example, Donald Trump is suing the Treasury Department and the IRS for $10 billion in damages in his capacity, no, as a not as the president, but in his capacity as a private citizen, and not as president. It's being borne out in a controversial case, and that came from unauthorized leaks of tax records relating to Trump and other high-profile figures. And this was done by Charles Littlejohn. He's an employee with a private management consultant firm, Booz Allen. They did have a government contract with IRS, but Littlejohn made a number of unauthorized disclosures of the information to whom, yeah, as you might guess, to the New York Times and Publica, and that's spelled Propublica. But in any case, Mr. Littlejohn has since pled guilty and is serving time right now in federal prison. So watch your steps, and for those in the listening audience who decide to use the legal system to sue the president, just keep in mind that the president can sue back. I think that one of the things that our listening audience have to be aware of is that the current administration delivered the single largest deregulatory action in United States history. And that was the step to remove endangerment findings, off-cycle credits, start-stop features that were contained in the EPA, Environmental Protection Act. They have announced that the Administrator Lee Zeldin made this announcement just recently that has been determined to be the single largest act in U.S. history. In the final rule, the EPA is now saving American taxpayers over $1 trillion, eliminating both the Obama era 2009 greenhouse gas endangerment funding and all subsequent federal emission standards for all vehicles and engines and models of engine years of auto model 2012 to 2027 and beyond. This action eliminates all off-cycle credits, including for the almost universally hated start-stop features. The Environmental Protection Act historic move restores consumer choices. It makes more affordable the vehicles for American families and decreases the cost of living on all products by lowering the cost of trucks. This major deregulatory process included a lot of public input and a lot of analysis of the law following the U.S. Supreme Court's decision in Looper Bright Enterprises versus Raimondo and West Virginia versus EPA. This endangerment funding has been the source of 16 years of consumer choice restrictions and trillions of dollars in hidden costs for Americans, as stated by Administrator Zeldin. So that has been a huge deregulatory action that just has taken place. The 2009 endangerment finding was justified trillions of dollars in regulations, including Obama and Biden's administrations. Um, I guess measures that were passed during the past administration. So keep in mind that if you would like to get further information on the removal of this endangerment finding that was used by past administrations to regulate greenhouse emissions, please call this station and request a special time be allotted to going into more of the impact of that decision. Because it has been huge, and it has just will be used to eliminate a lot of the mandates that have been passed and that have been put into effect over the past administrations. Okay, folks, let's get back to some of the changes that have been passed, improvements that have been passed in the One Big Beautiful Tax Bill signed last July 4th, 2025. As I mentioned earlier, as far as donations are concerned, the changes to the charitable write-offs, that's going to affect most people in 2026. And I think I may have mentioned earlier that beginning in 2026, folks who don't even itemize will start to be able to deduct, if you're single, up to $1,000 without itemizing. For if you're married, you'll be able to deduct up to $2,000, and that's for the 2026 tax filing year. The folks who do itemize, however, and C corporations don't fare as well. There are charitable deductions are going to get what they call a haircut. The donations claimed by individuals on Schedule A will only be deductible to the extent that they exceed 0.5% of adjusted gross income. The charitable gifts that are made by C corporations will be only deductible, are only going to be deductible only to the extent that they exceed 1% of taxable income. Now, even though you're going to get that haircut, if you wind up running afoul of those deductible limits and you have excess charitable donations, keep in mind they can be carried forward for 5 years. Again, you can carry those excess charitable deductions forward for 5 years. Keep in mind that the gamblers beginning in 2026, they're going to take a haircut too. And we'll go over that the closer we get to tax filing year 2026. As far as 2025 again, tax credits for electric cars and energy efficient home improvements. Unfortunately, folks, those tax credits are gone. The up to $7,500 credit for buying electric vehicles that ended after September 30th of last year, 2025, and the same goes for the qualified commercial clean vehicle credit, the residential clean energy credit, and the energy efficient home improvement credit. They expired at the end of 2025. If you are in a small business and you are really considered to be self-employed, and you receive a 1099 or a 1099 NEC, keep in mind that those thresholds for getting those forms, they will be increased beginning with the 2026 form, for the 2026 tax year. So there will be changes in the thresholds, and that's an area that keeps getting changed back and forth, oftentimes by IRS themselves, because they're getting taxpayer complaints and comment on those thresholds. Keeps changing back and forth. Now for folks who have a 401k and they're employed, for planning purposes, folks, you might want to know what the 401k limit is. Well, for the current, for 2026, the limit has been raised to $24,500, and there's catch-up changes too, that will allow folks, of a certain age, to catch up or put more money into the 401k that is normally under a limitation. But if you meet some age standards, you can put additional more money in without running afoul and having to pay taxes on that additional amount that you put into your retirement plans. It seems as though those limitations and the additional amounts that you can put into your retirement plans, they're literally changing every year, and that's because the cost of living has gone up so much that folks who do retire just need more money to survive. So there's an exception now to the 10% penalty if you wind up having to take some money out of your 401k. That's happened to a lot of people, and oftentimes you get hit with a 10% penalty on early payouts from your 401k. Well, that a change has been implemented, and for keep in mind that this doesn't go into effect this year, but for 2026 tax filing year, you're going to be allowed to take $2,600 of your pre-59.5 distribution per year to pay for long-term care premiums. And that would be basically a very good change, because even this tax reporter would win at keeping up the premiums on a long-term care policy. But this reporter is so glad that I just made the sacrifice and paid the higher premiums. But if you are in a situation where you're working full time and are contributing to a 401k plan, the law is allowing you an exception where you can take money from your 401k and use it for paying for your long-term care premiums. And again, that is going to allow you to take money out of your 401k before you hit that magical age of 59.5. If you take the money out, and you can use up to $2,600, wow, from your distributions from a 401k to pay for long-term care premium. But keep in mind, that's just in situations where you're actually needing money to pay for long-term care premiums. But as you will find out later, that it's worth using some of your retirement pay to pay for that long-term care premiums, for assistance in managing during your retirement years. As you've heard, if you have children, and this was mentioned in the president's State of the Union message last night, but they're called Trump accounts. I guess he wants to be remembered by everybody, especially the children who benefit from the new Trump account. But anyway, the Trump account can be set up for your kids under age 18 who have a Social Security number, by the way, beginning July 4th of this year. Up to $5,000 can be contributed to the tax advantage Trump account. You can contribute up to that amount. The government also put in $1,000 for each child born in the years 2025 through 2028. Most contributions, are not deductible. Payouts can be taken while the beneficiary is under age 18. After that, distributions are taxed in a manner similar to rules that apply to traditional IRA payouts. So just keep in mind that the account itself starts in 2026. And again, you can set up for any of your children, as long as they're under age 18, up through 18, you got to have a Social Security number. But the contributions really can't start before July 4th of 2026. So keep in mind that it really doesn't start, those Trump savings accounts really doesn't start until July 4th of this year, 2026. Contact your tax preparer or advisor, just to be sure that you're following the rules on those contributions to your children's accounts. You can are allowed now to take more money out of 529 plan tax free to fund a K through 12 education. Beginning this year in 2026, you can withdraw up to $20,000 per year for this type of schooling. Wow, that's an increase of $10,000 from the previous limitation. And more K through 12 expenses are covered. So there's no limit on the amount of tax-free 529 payouts to pay for college. For folks who have student loan debts, well, the easing on that, or the special treatment for handling student loan debt, has been repealed. Most student loan indebtedness, including Parent Plus loans that were forgiven in 2021 through 2025, is tax-free for federal income tax purposes. So those easing up on that, on the repayment requirement, as I mentioned, was forgiven in 2021 through 2025. And they were made tax-free for federal tax purposes. But there is an exception to the general rule that cancellation of debt income is taxable. The One Big Beautiful Bill did not, again, I mentioned, did not extend that relief past 2025. So keep in mind, folks, that if you have a college loan that were forgiven in 2026 or later year, that relief doesn't extend to this period. If it was, if the college loan was forgiven in 2026, or if it was forgiven in a later year, those are again generally taxable. Contact your tax professional, tax pro, to be sure that if you are attempting to get tax free treatment of that kind of a student loan, please contact your tax preparer for special help and to make sure that you're asking for something that you'll actually receive. Teachers can, beginning in 2026, if you're a teacher, you can deduct up to $350 for your out-of-pocket expenses in 2026. If both partners in a marriage are both teachers, you can deduct on a joint return up to $700 for both spouses who happen to be both in the teaching profession. There's an adoption credit that has been increased for 2026. Won't mention that until we're closer to 2026 filing season. And the lifetime estate and gift tax exemption for 2026 deaths rises to $15 million. That's for folks out there who have the type of income and who are watching their lifetime estate and gift tax exemption figures. So I'll try to keep you up to date, on some of these new changes. As I mentioned, the Trump account for the children actually began, July 4th, this year, 2026. This tax advantage savings account for young children who who do have to have a social security number and who are under the age of 18. And they're traditional Irish with some distinctions. But keep in mind, folks, you must elect to open a Trump account. It's not going to be um, just done out of thin air. So you have to elect to do that. And once you do elect, the Treasury Department will create an account for the child, which the parent would then be able to activate and open. So that has to be opened up by you and get your assistance with whoever does your taxes to make certain that gets opened up if you are in the status of being a parent and having a child born in 2025 and later years. But as I mentioned, the IRS has only released a draft form 4547, which you might look up, because the portal really will not be ready to go until the mid 2026, until the middle of this year, July 4th of 2026. So again, before we close out, please remind yourself of the baseball team that we are sponsoring. Please call Cicely Wooten at 951-534-3838. That's an easy number to remember, folks, to help this very deserving baseball team of 9 and 10-year-olds. 951-534-3838. And it looks as though we have reached the end of our hour. Please stay in touch with us and keep in mind the rewards from the station. And please send your calls to 951-522-9877 and email evjtax1@gmail.com.
All right, Ev. Hey, thank you so much for the information, guys. And if you like what you hear on this program, hey, tune in each and every Wednesday, 10 a.m. on the West Coast, 1 p.m. on the East. And make sure you come back tonight right here on The Buzz. Now, I'm going to invite that you download that app. If you have an Apple device, download Studio W from your Apple App Store. If you have an Android device, go to your Google Play Store and download Studio W. In the meantime, always go to that website, studiow.buzz, studiow.buzz, 24 hours a day, 7 days a week. Take it with you home, gym, office, or play. Enjoy your Wednesday.